And so the examiner's article is on page 87. The examiner's article is on page 87. And IFRS 8 on segmental reporting is on page 91. I think the reason that I put related party transactions and segmental reporting together is because what they both have in common is no debit, no credit, no measurement, no recognition issue. So both accounting standards are about disclosures. Segmental reporting. Segmental. A segment, yeah? So like an orange. Yeah, an orange will have segments. So let me give you the big picture, first of all. We spend our lives aggregating. So we present to our investors turnover, one number. Profit, one number. PPE, one number. Liabilities, loans, yeah, we summarize the balance sheet. And yet, those assets may be in Malaysia, maybe in America, maybe in Europe, they may be all over the world. That turnover may have been generated from oil, from gas, from exploration, from refinery, from chemicals. You look at what Petronas does, it's a very complicated business. It is involved not only in drilling for oil, but refining oil, selling oil, chemicals, lubricants. It has a range of activities. Now we are looking at one set of accounts. If we are a sophisticated investor, the question we would perhaps like to know is how much of the revenues and profits are upstream, how much are downstream, how much are to do with exploration, how much are to do with refinement, how much are to do with byproducts. Where is the revenue generated? Is it generated in Southeast Asia? What about the investments they have in America? How significant are those? So what we're doing with segmental reporting is disaggregating. Showing in the notes to the accounts the performance of various segments of the business. Now, in essence, the way that we define a segment, it's up to you. Yeah? The standard doesn't tell you how to define a segment. It simply says you define a segment however you want to. Yeah, just however you want to. Yeah? Providing that is the way that you run your business. How does your management look at the accounts? Because we have financial statements, but the management will run the business in arguably one of two ways. They will either say product A, product B, product C, product D. The management reporting system could be set up on a product basis. So you have lines of products that you're selling. Or the way the business could be organized is on a geographical basis. So take FTMS. I'm running an ACCA course here. I'm running an ACCA course in Singapore. So FTMS could, if it wanted to, have management accounts drawn up so that it would review its ACCA business, it would review its MBA business, It would review its business on product lines. Or it could review the performance of the business, this is internal management, along the lines of Vietnam, Malaysia, Hong Kong, Singapore. And actually what FTMS does is it reviews its business on country-wide basis, on a geographical basis. That suits us better, that is more logical. But it wouldn't be wrong to do it another way. What the segmental report is therefore doing is enabling the investor to see through the eyes of management, to be able to see the management accounts. And in fact, the segmental reports are drawn up are management accounts. So they may use different accounting policies from the financial statements. Yeah? And the segmental, the standard, doesn't tell you what to do with common costs, doesn't tell you what to do with common assets. It simply says, if you've got a head office, allocate it on a reasonable basis. So there's a great deal of latitude, there's a great deal of flexibility that we have in segmental reporting. I guarantee you will not be asked to physically prepare a segmental report. So you're not going to have to number crunch on segmental reports, nor are you going to have to interpret a segmental report. So it's not about number crunching, and it's not about preparation. It's about the idea of what a segment is and how effective the standard is. So the reason we have the standard is to help the user. Arguably, a user might be interested in Vietnam, and they would want to look at FTMS and understand whether the exposure to Vietnam was 60% of our business or 6% of our business. And they would gain an appreciation of that by looking at our segmental report. So segmental reports is about disaggregation, yeah, producing information in the notes to the accounts to help the users better understand our financial position and performance relative to our products, relative to our geographical regions.
So if you're not doing anything, so we will be coming up with definition only?
Well, yeah, if you give me a chance, I'll give you the formal definition. But what I'm saying is that, you know, two identical companies could very easily be run on different lines. Just because Petronas does it one way doesn't mean to say that Shell or BP, they could organise their segments in a different way, because actually it's about management accounting. We're actually exposing in the notes to the accounts management accounting. And that's a bit weird. It's a bit weird. I've got a very slightly sore throat. Are you live tweeting this? So, what's the purpose? What's the purpose? Yeah, what's the purpose of segmental reporting? To help users better understand. To help users better understand the nature and financial effects. To help users better understand the nature and financial effects of different business activities, of different different economic environments. So arguably, different activities have different risks, different rewards, different countries have different risks, different opportunities. The scope is listed companies only. The scope is listed companies only. Otherwise, it's TMI. Otherwise, it's too much information. So it's only applicable if we are a listed company. I have a definition of a segment. It's not a very good definition, but it is the definition within the standard. A segment is a component of the entity. So that implies it might be a subsidiary. It's something that has to be distinct. It's a component of the entity that engages in business activities. That engages in business activities. That implies it has a revenue. That implies it can make a profit. A head office is not engaging in business activities. Whose results are reviewed by management. Whose results are regularly reviewed. They're regularly reviewed by the chief operating decision maker. The boss. Yeah? The boss. And financial information is available. Financial information is available. Discrete, separate financial information is available. So what is a segment? It is a part of the business, a component of the business. Could be Vietnam, could be Malaysia, could be a product A or product B. But it's a part of the business that engages in a business activity, sells, generates profit. Results are regularly reviewed by the chief operating decision maker. So therefore, who is on the board of directors? Is the person on the board of directors responsible for a geographical region, or is the person on the board of directors responsible for a product line? How is the internal organisational run? And the financial information is available. What we're looking at is management accounts. What we've got to disclose is the revenue, the profit, the loss, the assets, the liabilities. We're making a disclosure. Yeah, we have a disclosure per segment. We have a disclosure per segment. We have a disclosure per segment of the revenue, of the profit, or the loss. So we've got the disclosure of the revenue, the profit, the loss, and the assets and liabilities of each segment. These are management account figures. Look, I did F9. I did my management accounting paper. I passed it. Absorption costing, marginal costing, budgeting, all that variance stuff. Yeah. And luckily, I've never looked at it again since. Yeah, but it doesn't change, does it? Management accounts, it's rubbish, really. Sorry. I like the discipline of financial reporting. You have to comply with standards. Management accounts, there's no standards to comply with. You can do what you want. That gives you greater flexibility. That gives you relevant information, forecast information, whatever. So the point that I'm trying to make is, if you're looking at management accounts, they may not very easily reconcile with the figures in the financial accounts, and they could be used different policies. So these are management accounting figures, and therefore they may use different policies. They may use different policies. They may use different policies. And therefore they would allocate common costs, common assets on a reasonable basis. And therefore they may contain transfer pricing. They may contain transfer pricing. They may contain transfer pricing.